Wouter, Henderson Global Trust. The performance has picked up since you took over in February. What can you assign this to?
I think there's a couple of factors that have driven performance. One is relative concentration within the global trust. So we've narrowed the number of names that we're invested in, and we've been lucky with a couple of our stock picks going fairly well. Secondly, geographical positioning. We started the year with a 10% underweight in the US, and we've more or less closed that. And that has benefited us because the US was not only the strongest performing equity market this year, the US dollar was also the strongest performing currency. And then lastly, we've benefited from being overweight large cap stocks. So about 80% invested in stocks with a market cap above 20 billion throughout the year, and large caps have outperformed smaller and mid cap stocks in 2014.
Now, change has been a thematic driver in the portfolio. Can you explain to investors what this is?
Yeah. So what we believe in is if you want to outperform the market, you need to invest in something different than the average investor. You need to find stocks where you can see numbers that are ahead of the street or a valuation that is not fairly reflecting what a company is worth. But we believe that the market's fairly efficient. For most companies, the stable, the boring companies, the market does a pretty good job at forecasting this earnings growth or forecasting the valuation. Where the market tends to struggle, though, is when there's a lot of change going on. Like most human beings, investors struggle with things that are changing. And so we look for companies where there's a lot of change going on, not just on a corporate level. So it's not just company restructurings, it's things like industry consolidation, a change in a product cycle, for example, that we look for. So a lot of change brings a lot of confusion, and on the back of that, we can come up with numbers that are significantly different than what people assume or forecast, and put a different valuation against that, and then outperform the market.
Finally, Wouter, this is a capital growth portfolio primarily. What's your approach to dividends?
Yeah. We also have a reasonable dividend. We pay out 2.8% dividend yield at the moment, 10p. And I think what sets us apart from traditional dividend funds is that we're not dividend only. So I'm not restricted to only invest in dividend yielding stocks. I can add a high dividend yield stocks. We've added CTT, the Portuguese postal office, lately to the portfolio. That's a 6% yield stock. But we've also added Dollar General, which is a US retailer, which we think is quite attractive, but does not generate any dividend yield. They're buying back shares instead. But combining that still gives us a very healthy dividend yield above the yield that most global managers are generating. But we're not purely restricted to investing in dividend yielding stocks, and therefore overall sentiment towards dividend yield. And the final thing that I'd like to probably add is that the trust also has 2.6 years of revenue reserves. So our dividend yield is quite safe. We've got a big capital buffer to continue to pay that out in the coming years. And we also generate quite a big yield in the underlying stocks in the portfolio.
Wouter, thank you.
You're welcome.